There are moments in economic history when stability becomes as dangerous as volatility. Europe, as it stands in 2025, is learning that lesson once again. The continent that spent the past 3 years fighting runaway inflation now faces a subtler but no less dangerous adversary: stagnation. Prices have cooled, but so has growth. Interest rates have plateaued, but so has confidence. For a financial analyst observing the Eurozone's pulse, it feels like watching an athlete who finally stopped sprinting after a marathon, exhausted but unable to rest. The inflation crisis that gripped Europe in the early 2020s was unlike anything the bloc had experienced since its inception. It wasn't just the result of monetary policy errors or post-pandemic supply disruptions. It was a perfect storm. Energy shocks from geopolitical turmoil, structural weaknesses in industrial competitiveness, and decades of underinvestment in productivity. By 2023 and 2024, the European Central Bank (ECB) responded decisively, pushing interest rates to levels unseen in over a decade. The move worked. Inflation gradually retreated from double digits to the ECB's target corridor. But the side effects are now evident: weaker industrial activity, flat consumption, and fading investor appetite. From a macroeconomic standpoint, Europe's current challenge is not the presence of inflation, but the absence of momentum. Across the Eurozone, GDP growth projections hover between 0.5% and 1.2% for 2025. Germany, long the locomotive of the bloc, is running on fumes. The German model, export-driven, energy-intensive, manufacturing-heavy, is faltering in an era where trade fragmentation and decarbonization redefine the rules. High production costs, labor shortages, and dwindling demand from China have turned the once reliable engine of Europe into a drag. France, meanwhile, faces political turbulence that makes consistent fiscal policy difficult, while Italy and Spain remain trapped in the delicate balance between reform and populism. One might argue that Europe is in a phase of silent stagnation, not a recession, at least not in the traditional sense, but a slow erosion of economic vitality. The numbers look stable on paper, but the energy behind them is fading. Corporate investment, especially in traditional industries like automotive and chemicals, is cautious. The private sector, wary after years of volatility, is hoarding liquidity instead of expanding capacity. Even household spending, buoyed by wage increases in 2024, is losing steam as high interest rates keep credit expensive and housing costs stubbornly high. What makes this moment particularly delicate is that Europe cannot afford to lower its guard. Inflation may have slowed, but it is not fully defeated. Service prices remain sticky, energy markets are unpredictable, and any external shock, from renewed tensions in Eastern Europe to another disruption in global supply chains, could reignite the fire. The ECB is therefore trapped between two imperatives: protect its hard-won credibility by keeping policy tight, or risk suffocating what little growth remains. The choice is not purely economic, it's psychological. Markets have grown accustomed to central bank intervention, to the promise that whatever it takes will always apply. But in this new era, patience and restraint might prove the real test of leadership. Still, the Eurozone's story in 2025 is not purely one of gloom. Beneath the surface, structural shifts are occurring, slow but meaningful. The transition toward renewable energy, though costly, is gradually paying off. Europe's dependence on Russian gas is now a memory, replaced by a more diversified, albeit pricier, energy matrix. Countries like Spain and Portugal, once seen as periphery economies, are becoming hubs of green investment and digital transformation. The irony is striking. The very regions that once symbolized vulnerability now represent adaptability. Southern Europe in particular has found a pragmatic rhythm. Portugal's blend of fiscal discipline and innovation incentives has attracted foreign capital. Spain's tourism sector, revitalized post-pandemic, has evolved beyond seasonal reliance, incorporating digital services and sustainable infrastructure. Even Greece, often invoked as the Eurozone's Achilles heel, is recording steady growth thanks to targeted reforms and investment inflows. These shifts, while insufficient to offset the broader slowdown, demonstrate that resilience within the bloc is not evenly distributed, and that might be its saving grace. The question that dominates boardrooms and ministries alike is whether the ECB can pivot without losing credibility. Analysts are increasingly divided. Some argue that a gradual rate reduction in the second half of 2025 is necessary to reignite lending and business confidence. Others warn that premature easing could reawaken inflationary ghosts, especially with the U.S. economy still running hot and global commodities remaining volatile. The euro, meanwhile, reflects this uncertainty. Steady but fragile, oscillating between investor caution and faint optimism. From a capital markets perspective, the Eurozone remains a paradox. Bond yields are attractive again, particularly in the periphery where risk premiums have stabilized. Yet, equities tell a different story. Investors are wary of low growth and political fragmentation. The fragmentation of fiscal policies within the bloc only adds complexity. While northern members like the Netherlands and Germany advocate for spending restraint, southern economies emphasize the need for fiscal flexibility to sustain reform momentum. The debate is old, but the stakes are higher than ever. A broader philosophical question emerges. What should Europe aim for in this new equilibrium? For decades, the Eurozone's identity rested on stability. Low inflation, fiscal discipline, predictable growth. But the world has changed. The U.S. thrives on flexibility and innovation, China on scale and state-directed strategy. Europe, caught between these models, must now redefine its economic purpose. Is it content to be a steady, if slow, continent of regulation and resilience? Or can it reinvent itself as a hub of innovation, sustainability, and strategic autonomy? Signs of reinvention are visible. The European Commission's investment programs, focused on AI, clean energy, and digital infrastructure, signal a willingness to adapt. Private capital is following suit, albeit cautiously. Venture funding, once heavily tilted toward the U.S., is finding renewed interest in European startups tackling green technology and fintech innovation. In this context, stagnation might not be a symptom of decline, but a pause before realignment. The structure of Europe's economy is shifting toward long-term sustainability rather than short-term exuberance. Yet, time is not on Europe's side. Demographics weigh heavily, labor markets are tightening, and productivity growth remains stubbornly low. To move beyond stagnation, the continent must embrace risk, the one thing its policy culture has long resisted. That means investing not only in technologies but in talent, allowing for regulatory experimentation and building deeper integration between fiscal and monetary strategies. As an analyst observing these dynamics, I see 2025 as a defining year, not one of crisis, but of calibration. The Eurozone doesn't stand at the edge of collapse. It stands at the threshold of transformation. Its success will depend less on immediate growth numbers and more on its capacity to adapt structurally, to balance prudence with ambition, and to treat stagnation not as fate, but as a challenge to overcome. In the end, Europe's greatest strength has always been its ability to evolve under pressure. The inflation storm tested its endurance. The coming years will test its imagination. And in that sense, the story of the Eurozone in 2025 is still being written. Slowly, perhaps painfully, but with the unmistakable rhythm of a region that refuses to stand still.